Yeah.
Good morning. It is Thursday, March 12th. We are going to start our day looking at H 917, an act relating to military affairs that we received from the Government Operations Committee. And then we're going to continue our work on miscellaneous tax bill, including the federal link up, until lunchtime. We need to vote that bill by the end of the day tomorrow. We have certainly looked at all of the sections of it 5 ways to Sunday, but the federal link up stuff is sort of ever changing. And so we're going to have some updates on that and testimony from the tax department. And then this afternoon, we are looking at regional assessment districts and the tax classifications again. But if we need more time, we need more time on the federal link up, we can take up some of that afternoon time for that. And that's where we are. We don't have any bills on the floor this afternoon. Oh, I guess we have third reading on animal cruelty. But I can't imagine there's gonna be a fiscal question on that one. So,
I don't know, it's 588.
okay. And so we'll do that tomorrow. Great. Okay, with that, Sophie, welcome. Hi.
Hello. Good morning, Sophie Zadatny for the Office of Legislative Counsel. So again, we're here on H 917. This was an omnibus military affairs bill, so it actually pulled together 4 different bills that were in front of House GovOps. So it's a long bill, so unless you're really interested, my suggestion would be to skip the first 40 sections, because really what those do is essentially correct from being the adjutant and inspector general to being the adjutant general. So historically, the 2 roles were combined, and then over time it was too much. And so the duties got separated. And right now at the National Guard, there is a separate inspector general. So it's just a cleanup, but because the reference is in so many sections, it takes up a lot of the bill. So if that's okay with you, I would suggest that we skip ahead.
Thank you.
I kind of hate doing this on screen in case anyone gets sort of queasy, but just don't look at it for a second. The one other thing that section does, section 5, is it just contains a cross-reference to the election for the adjutant general. So right now, all that's dealt with in Title 20, but under the General Assembly votes, as you know, on the adjutant general, so that's in Title 2. So there's just a cross-reference to make sure anyone that's interested in running can actually find the language in section in Title 2. So in section 5, that was the only other substantive piece in that. Okay, so I'm on page 21, section 40, Gold Star family member. So there is no single federal definition of a Gold Star family member. Historically, it tends to be for families who have a member of the family that was killed in combat, but each state can define a Gold Star how they choose to do so. And so this is a request to add a definition for Vermont, and it expands it just from those who died while serving to those who also died from a service-connected illness or injury. And this is proposing putting it in Title 1, where there's a whole list of how statutory terms, words are to be interpreted. But
The phrase U.S. Armed Forces include all the
branches.
branches.
Yes, it does.
Coast Guard.
Yeah,
Okay,
yeah.
great. Okay, thank you.
Space Force, Space Force.
Space Force as well, yes. So the only place currently in Vermont statute that references Gold Star is actually to do with number plates in Title 23. And so right now, the way it works is you can have a Gold Star plate, again, if your family member was killed in combat, or a next of kin plate if they died from a service-connected illness or injury. So by broadening the definition of Gold Star to include service-connected injury and illness, you kind of remove the need for the next of kin plates. So that's what this section does in section 41, is it's taking away the next of kin plates, because now that's going to be part of the broader Gold Star plates.
I have a question regarding the verbiage where you stated Gold Star member means, and it goes on to say who died while serving. while serving is different than died while in a combat situation. And I realize that the state has a different definition, but it seems like if you die while serving, on active duty or in the Guard, I don't know whether it's justification for awarding a gold star to a parent. Do you see where I'm going with this?
Yeah, so the request for this definition came from folks on the Governor's Advisory Council. I forget what the name is. And this is sort of modeled on what the definition Massachusetts has. So this came from the military community, this language. So that's really all I can tell you on that. I mean, there was debate around it in terms of sort of how specifically to do it. There were a couple of different versions, but this was the version that the committee ultimately landed on.
So if you're thinking, if you're working a warehouse down in Guantanamo, then I never.
Well, yeah, and you have a heart attack,
Yeah.
while just doing and I'm not saying that isn't important, but, gold star, I think of somebody dying in combat. But that's just me.
Yeah, and I feel like this is wading pretty deep into the other committee's jurisdiction, so I wonder if you want to take it up with them. Yeah, Representative Campbell.
So I'm looking at it, and I think it addresses those who come home from Afghanistan and then suffer from burn pits.
Right.
Yeah, that would cover them here, service-connected illness.
Yes, towards that end of that sentence, or from a service-connected illness or injury. It's just a comment.
Totally serious.
Right, so section 41, again, just deals with the next of kin plates. Section 42 is a hiring preference for military spouses. This is specifically for state employment, not, but government employment in the state. And so what this does is, right now in Title III, there are rules around when you're looking to hire somebody. And so this provides that after the requirements for an applicable collective bargaining agreement have been satisfied, after compliance with subsection 327A provides that any vacancies in state government you try and fill them internally first. And then consistent with applicable state or federal standards for affirmative action, it then provides the state shall make a diligent effort to recruit, interview, and hire. And again, this is the current language is veterans, spouses of veterans who, if the veteran receives disability compensation. And then what's being added here is the spouses of personnel currently serving in the U.S. Armed Forces. So that's step one. And then step two is under this subdivision 2, veterans and spouses of personnel currently serving in U.S. Armed Forces. And this is for any open competitive recruitment that involves a point-based examination. As long as the person passes, they then get an additional 5 points added, and then some other folks get an additional 10 points added. The Department of Human Resources confirmed that the only competitive examinations that this would apply to is currently for law enforcement. The state as a whole doesn't have sort of civil service exams generally, but so again, there's two places here where you would provide sort of a preferential hiring. And that's one is, for vacant positions, again, once you've gone through all the other requirements, and the other is the additional points on point-based examinations.
So just a question, did they check what the scale was under that? I mean, 5 points is kind of arbitrary.
I know it's 5 points for, again, they have to pass the exam and they get the extra 5 points, and then other folks get an extra 10 points. But yeah, there was no testimony specifically on that, just that the only place where this comes up currently is either through the police academy or, other hiring of law enforcement officers. So I don't know how meaningful that is, right? If it's on a scale of 20 or 100 or 200, right? It makes a difference.
The test in the middle.
Right. So yeah, there wasn't any additional information on that.
I believe it follows federal guidelines as well. If you're applying for a federal job, you meet the qualifications and you're a veteran, you automatically get 5 points.
Huh.
And there has been there has been a promotion to also include military spouses as well, for federal positions as well. So, and the reason for that is, on active duty, you're constantly moving around, and your partner, spouse, is not able to maintain a job because her or his spouse is moving, and you move with that job.
And that was the policy
Yeah.
reason behind this, yeah.
I would say at one time, I'm not sure if it still applies, postal service, US Postal Service, or like General Electric in Rutland. They get federal military contracts. So that point system might work there.
What else do we have in here?
Right, and so the last section is parking for disabled veterans, so
I
this-
think this is the section why the
Yeah,
is here.
assuming.
Also not very much.
right, so what this does, and this was not originally my bill, but I will do my best to answer any questions you may have on it. This is to basically to provide, this is in the section where it lists out what the powers of municipalities are. And it provides a vehicle with disabled veteran plates issued by any state shall be permitted to park at a parking meter without fee. So that's really what this provides. As far as I can tell, to obtain a disabled veteran plate here in Vermont, you have to meet the same criteria as you would to receive a regular disability plate. So there's not really changing, you know, if you're a disabled veteran right now and you're eligible for a disability plate, you would be able to have a disability plate and park. It's more the issued by any state. Each state has different requirements for what level of disability you're required to meet to be a disabled veteran. But this is simply providing that, individuals with disabled veteran plates are able to park.
So under current law, if you have a disability plate, regardless of veteran status, you can park at any parking meter without a fee?
So that's a different statute. So that's 304A. And there is language on that, and I can pull that up.
I don't need to see it. It's just,
Oh,
if that is
yeah.
vaguely true, then that's gonna be.
So I think it is slightly different. So for disabled plates, they can park in disabled spaces and they can park sort of for up to 10 continuous days, regardless of sort of timing on that. So I think there is a difference
And
here.
so I just wanted, like, municipalities have some idea about this already being a thing. That's really mostly what I'm.
Right, right.
Okay, thank you.
And that's it.
Chris, is there any fiscal impact to the state?
Chris, for the fiscal office, we do not see any fiscal impact to the state or any meaningful impact to the Department of Motor Vehicles as a result of the change. There are not many of, just for perspective, I think there are fewer than 300 disabled veteran plates out there. And, not every municipality has metered parking, so we wouldn't do an estimate for fiscal impact to municipalities, but we can't imagine this would be significant to any individual municipality.
Thank you. Any more questions for Sophie? Thank you. Did you have one?
Only for Chris,
Oh.
it's the 300 is only Vermont issued or is.
Correct.
Plates on the
Correct.
ground. So this applies to any state.
And it's fewer than 300. It's
Right.
around.
So this bill applies to issued by any state. So. Okay,
So do you know how many disabled veteran tourist plates might come in?
I have not had the opportunity to explore that question yet, Madam Chair.
Okay. Do you imagine there would probably be a disabled impact?
I would imagine so.
Great, thank you, Sophie. Anyone new want to make a motion on the bill? Mix it up, team.
Madam Chair, I don't know, Woody, but.
Oh, you should go, Woody.
Oh.
Representative Page, would you like to make a motion?
I move that we approve H917, an act relating to military affairs.
Wonderful, thank you. Representative Page moves that we find H917 favorable. Representative Holcomb, second, any discussion? Seeing none, if quick, please call the roll.
Representative Brannigan. Yes.
I'll vote yes as Representative Burkhardt, Representative Higley,
Yes.
Representative Holcomb,
Yes.
Representative Kimball,
Yes.
Representative Maslin.
Yeah.
Representative Odie,
Yes.
Representative Page,
Yes.
Representative Wazazak,
Yes.
Representative Canfield,
Yes.
and Representative Kornheiser.
Yes.
We have voted the bill favorable 11-0-0.
Thank you, everyone. Mark, are you interested in reporting this?
I've got enough on my plate. and,
I'd be. Just,
I have you left, so I'm glad you deferred to someone else.
Yeah.
Good to give Representative Page the opportunity. Thank you so much, Sophie.
You're welcome.
just the financial impact.
Yes.
Yes.
And our two witnesses, yes. One.
Oh, I'm sorry. I didn't see you in the big chairs.
It's all right, I get that a lot.
Okay, let us switch gears. We are going to discuss the federal link up a little bit more, have a slightly different proposal for the committee. After some conversations I was able to have with the tax department and accountant. And I'm gonna have Pat kick us off. If that's okay with you, Pat.
Sure.
Yep. We're gonna take a brief breather, because we're running 3 minutes ahead of schedule.
Bye.
Guess you gave my laptop 3 minutes to do its thing.
Okay, let's take a 3 minute break.
It finally,
You're done.
I still need to do it. I wasn't expecting to jump Kirby.
I feel like this will be, Kirby's language will be easier to follow if we start with.
Sure. I'll keep it simple. It'll get really complicated on you. I should probably say I'm Patrick Tate, I'm in the joint fiscal office. Well, while I'm logging in, there are slides under my name on the committee's website. Going to walk the committee through just the revenue changing provisions that are in the language that Kirby will share with you, and I'll summarize what those changes are. Some of them will look familiar. I've talked about some of these HR 1 provisions that are flowing through the state, you know, those things that are sort of above the line and affecting state revenues, particularly if you all opt to conform. And when I do get in, I think maybe I'll actually start with showing you or reminding you what it looks like if the state were to normally conform, you know, as you know, Vermont does in many years. And what that impact sort of means for both the budget that is currently being worked on and the budget for the year that we're currently in. You know, the one that you all passed last year, that you just had a budget adjustment for.
We're just signing.
Yep. And, you know, all of it is been very like sort of fluid situation as we in the tax department have. So I'm going to skip to words again. Okay. Okay, so this is with normal conformity, sort of the situation that you all are looking at. If you were to just move the tax year that we're linked up to up 1 year, which would conform me with HR 1. You can see that in the tax year, the fiscal year that we're currently in, JFO in conjunction with the tax department, are estimating that that would result in about a $21 million shortfall. And so just sort of mechanically, how that sort of works is Tom and Jeff come out with a consensus forecast for fiscal year 26. You build a budget based on what the fiscal year 26 estimates are. Once you get into, so that passes, then you get into when the session starts back up. You have budget adjustment, and this is after Tom and Jeff have updated with the January forecasts. And the budget adjustment will true up to the updated January forecast estimate for fiscal year 26. So that has come and gone, right? And as we've gotten more information from other states, from federal report releases, and actually talking to a lot of the accountants, we have gleaned some additional information on sort of cash flow for a lot of businesses. We've been able to sort of update with the additional information that we've been able to get. And so that's where we get to this sort of unhappy surprise of, well, there's about $21 million in unaccounted for revenue that has not been captured in the fiscal year 26 budget or in the Budget Adjustment Act. And so that is sort of the starting point or the situation that you're facing, and sort of gives context for some of the decisions you need to make, right?
So there's a $21 million loss that we didn't realize.
For fiscal year 26, yes.
Okay.
And well,
If we conform.
if you were to conform, right? So that's where you need to be making active decisions on what things you might want to conform to, what things you might want to decouple, other areas of state tax law where you might want to make some adjustments to account for that. And so,
So the governor's recommended budget did not account for this loss of $21 million.
yeah, so just like the legislature, the administration didn't have this information at the time that they were operating. So, so that's talking about fiscal year 26. You can see that the budget you're building right now for fiscal year 27, if you were to fully conform, that's a $33 million potential shortfall if you were to fully conform. So these are just kind of two areas where you have some decision points, and your appropriations colleagues will be very interested to see what you pass along to them.
And so Pat, since the budget adjustment already passed and signed into law, if we did fully conform, that $21 would basically be carried over into FY 27. And so we would have like a $50 million hole in the FY 27 budget.
Ooh. I'm not quite sure exactly how the math on that works, although I do know that there was a 75-ish million dollar carry forward in the budget adjustment. Although you're hoping to use that to spend on things. But I think that sounds right.
I just want to take like a brief moment here to make sure, like, we've gone through this a lot, but we need to vote on this tomorrow. And so I want to make sure folks understand the impact of full conformity and how much it was not accounted for, because it was information that no one had through no fault of anyone. Okay.
So with that, I'm just gonna,
I'm going again.
Slow on this, but
No, that's why I paused.
do we know why we didn't get this accounted for?
I think basically no one knew because it was brand new law, but Pat can explain it in a little greater depth.
yeah, so when Tom and Jeff create the consensus forecast, they're basing it on current law. So in Vermont being a static state, technically speaking, although we kind of operate in a rolling way, Vermont being a static state, the current law would have been pre-HR 1. And so any decision to actively link up or decouple is considered sort of an active legislative action. So that would not be considered current law. So the basis that they're working with is current law as a starting point. In terms of how, information is sort of rolled out, a lot of what we're talking about here is business and corporate, which kind of operates often on a bit of a lag. So, they're making estimated payments. They're making decisions based on either what Vermont current law is or expectations of what Vermont law is going to be. And really, the other piece of the whole thing is that we really have a dearth of information in terms of what we can see from, because a lot of these changes are happening sort of above the line before the starting point for Vermont corporate income tax and other business taxes. So we really don't have that insight into the specific IRS data that of these things that are changing that would flow through to Vermont. So it's kind of like fumbling around in the dark a little bit with some of it. But as we got through the last quarter of 2025, and some corporate estimated payments coming through then, as we got through we're getting through the first quarter of 2026. Again, we're seeing sort of behavior of businesses and their estimated payments coming through. I think that, and that's them reacting to HR1 in real time, right? So as we've gotten some of that new information, the receipts that are actually being collected and how that's comparing to what, Tom and Jeff forecasted based on current law, I think that's where JFO and in conjunction with the tax department have really been able to sort of feel a bit more confident about updating some of these numbers and looking at, well, JFO can't do this, but the tax department can, looking at some of those returns and sort of the cash flow and when money is actually being remitted to the state and what the magnitude of some of these potential changes are starting to look like. So does that kind of answer your question?
Yes.
And the last thing real quick is just that corporate tax in and of itself is typically very volatile and can be very unpredictable. It's a unique tax type.
Thank you. It looks like your slide 11 is going to explain this, but I want to make sure I understand it. So that deduction for domestic research and experimental expenses isn't a full pullback from the feds. It's based, small businesses are still going to be allowed to take it.
That is like what we're about to do.
Yeah.
So.
So my goal is I'm going to give sort of the summary of everything that's in Kirby's language that has tax revenue implications. Kirby will hit you all over the head with the nitty gritty details.
Okay.
But
Thanks.
And that question is sort of the core of what we're going to spend time.
Well, I'm just, looking at the bottom line.
Yes.
Okay. thanks.
so I guess before we jump in, the R&E proposal you see here is vastly different than the one that I was in here talking about last time I was in on this subject.
Thank you, because I.
Yes. Okay. So some of these changes are going to look familiar. Just as a quick summary, there's sort of three buckets I consider in terms of revenue changes in this bill. One is areas where on things that will flow through, the language you'll see is proposing to link up to federal treatment. The second bucket are areas where the language is proposing to decouple in certain ways. And then third is adjusting or altering existing state policy, not necessarily connected to federal treatment of anything.
I think the annual cap is one.
Oh, sorry for the village center. No, I sent, yes,
Okay.
the slide later
Yeah.
has that correction. That was one thing I missed for Sorsha this morning. Sorry about that.
Okay.
So starting with areas where we're linking up, the federal government changed the phase down for the child independent care credit. Previously, it was set at 35% reimbursement rate for expenses. And it was the same regardless of filing status. It phased down to, I think it's 25%. This new change for lower income filers and claimants increases that reimbursement rate to 50% of expenses. And so these are all things that are happening to a federal credit, which is typically below the line and would not affect Vermont, but Vermont has set up in a way with this credit and a couple others where we take a percent of the federal credit. We're at 72%. And so in that way, this change is flowing through. So really what this is doing, and maybe if we look at the next slide, you can see how the treatment changes. These lines show you the reimbursement rates, both for pre-HR1 and post-HR1. The green refers to TCJA treatment, while the blue and orange refer to HR1 treatment. So you can see that up to about $15,000, those individuals can have their child's care, dependent care expenses reimbursed at a 50% rate. And then that scales down and has different plateaus based on your filing status. But you can see that it really effectively what it is doing is making reimbursement rates at lower incomes more generous. So that is something you'll see the language is proposing to have flow through.
Before we move on to the next one, I just want to say there's a few things. One, we sort of proactively increased that a few years ago. And in like an ideal world, the tax study, the 10-year tax study would be done in advance of this federal flow through decision having to be made, but it's not because the world is very much not convenient like that lately. And so like, I hope that whoever's at this table next year, like takes the time to check back in on this and to see how it overlaps with all of the other pieces. Because Representative Holcomb, you've been bringing that up regularly. I think you have a really good point. Leaving the flow through out of this bill seems unnecessarily feels unkind to me, actually, is probably the best way I could explain it. But I think it's worth doing more analysis of how all of our tax credits overlap for that population.
I don't disagree.
Yeah.
And maybe Kirby could expand on this if he wants to, but I think that would also be something technically difficult to not let flow through because we're at a flat percentage of the federal calculation. Yes. Okay. So the second piece in HR1, there was an amended limitation on business interest deduction. Essentially, at its root, what this did was increase the amount of business interest that can be deducted from 30 to 50%. There are some limitations on how much overall business interest you can deduct, but essentially the core change there was increasing from a 30% rate to a 50% rate, the amount of business interest paid that can be deducted. So you'll see that the language is proposing to conform Vermont with this federal treatment. Second, there was in HR1, there was a limitation or a change in the limitation on expensing for depreciable business assets. This is specific mostly for small businesses. And rather than depreciating these assets over a extended period of time, what this would allow them to do is expense a greater portion of that upfront. What it's doing is increasing the cap that can be expensed right away from 1 million to 2.5 million. And you'll see that the language is proposing to conform with this federal treatment. There's the.
Yep, sorry.
Yes.
I wish I had said all this at the beginning. So we're gonna look at this deep all morning. We're gonna have a chance to touch it again this afternoon if folks want to. And then we're gonna look at it again tomorrow morning, and then we're voting tomorrow afternoon. I did not give my usual public service announcement that we're gonna work tomorrow afternoon because it's crossover week. I assume that everyone had already assumed that, but just want to sort of say that. And so if anyone is this is my second public, if anyone's planning on being absent tomorrow or for any minutes at all next week, please do let me know because we're scheduling votes, obviously. And you all know that you've been around. So, okay, back to you.
And I do know I'm moving a little bit quick. My goal right now is to give sort of a higher level summary, which Kirby will then expand on. If at any point I'm going too fast, please let me know. Okay, so that is for expensing for depreciable assets. HR1 also did make some changes to pro rata share rules. And it changes the treatment of what this does is change the treatment of controlled foreign corporations. Just as a quick reminder, a CFC is a foreign corporation that has at least 50% of the voting power or value of the stock owned by US shareholders. So what HR1 is doing is saying that each US shareholder must include in their gross income their pro rata share of the CFC's passive income in that tax year. So in effect, what this says is that taxpayers who hold stock in CFC would have to see an increase in the gross income that they have to report on their tax return. And this is something that the feds would be capturing. It would go into your AGI calculation and flow through to Vermont. And you'll see that the language is proposing to conform with this treatment. So again, something that would be flowing through to Vermont. Charitable deductions for corporations. Previously, you could deduct up to 10% of your taxable income if you're making those contributions. What the HR one is doing is setting a floor where you have to make charitable contributions above 1% of your taxable income. And you can deduct that amount between 1 and 10% of your taxable income, whereas previously it would have been between 0 and 10%. So it's just basically taking a percent off the bottom of the range for the amount that you can deduct from your taxable income. And so you'll see that the language is proposing to conform with federal treatment on that.
Assumptions assume that it won't encourage corporations to increase their donations to more than 1% in order to deduct them.
Well,
Which is reasonable.
So I think I understand why it was structured in the way it was, rather than saying you can only deduct 9%, because it does require that you make those charitable donations to get into the range, right?
Yeah.
And so now we'll get into sort of I think the most substantial change from what you all saw last and getting at some of your questions. But as quick background, so HR1 changed how corporations calculate their R&E expenses deduction amount. So starting in 2022, TCJA said that these expenses were required to be amortized over a 5-year period. Prior to 2022, corporations and businesses could fully deduct those expenses in the year that they were incurred. So you went from a regime where you could fully deduct these expenses in the year that they were incurred to then in 2022 having to amortize over a 5-year period. And so now what HR1 is saying is that we're going to go back to the pre-TCJA treatment, which means that you can fully deduct these expenses. If you remember from the very first table that we looked at, that is probably the most significant cost driver to the state if we were to link up to that fully. In fiscal year 26, that was, I think, a $19 million negative revenue estimate. And also, part of why it's so expensive is that it's also acting retroactively, where any amortized or capitalized expenses going back to 2022 that a business has incurred, they can go back and claim all of those now. So it's not just changing to full expensing for this year. It's saying you can go back and anything that you haven't claimed yet, you can claim all that right away too. So in effect, what that does is it really front loads the cost of this. And there would be a front loading of the cost of this regardless of whether it was retroactive, just because of the nature of it. But it's one of those things that in the long term, ultimately ends up being sort of a net. We're back at baseline. It doesn't cost us more than it used to. But during that transition phase, that's when this linking up to that proposal would be really costly to the state. And it really is driving some of those big numbers that you saw in that very first table I shared with you.
Sorry. The operative word is that they can, not have to. So is there any sense that all businesses are going to front load everything? Because people manage their deductions and their expenses to minimize revenue exposure just generally. So is there a sense already of how people are responding?
Well, yeah, so we've looked at some other states and the sort of how their corporate revenue collections have been looking. And one thing that kind of stood out is that rolling conformity states, those who sort of link up automatically, have really been seeing corporate revenues declining or, not hitting forecasted amounts. In states where they have a static regime, One particular example I saw was Wisconsin. So they're not automatically picking this up. They're kind of chugging along like they normally would expect. So there does seem to be some link there. And, if you're a business or corporation, if there is something you can do right away to lower your tax liability, you're gonna want to do that.
So you're doing it another year by design, right?
Yeah.
Yeah.
And I think, particularly in very like economically unstable.
That's sort of, I'm just wondering what the leading indicators are.
Yeah. And this fall, we saw those revenue drops and we just it wasn't entirely clear yet what it was from.
I think we're gonna see a lot of things like this.
Indeed.
So that's the background. What the actual proposal on the table is so the language would do two things. So it would conform Vermont to federal treatment, so the full expensing in the year these costs are incurred for small businesses only. On the other hand, it would decouple from HR1 treatment, so the full expensing, and go back to sort of stay static to the 5-year amortization treatment that, previously businesses have been used to for large businesses. And so there is a definition for what a small business is. It's defined in federal code as a business with average annual gross receipts over 3 years. So it's the average over those 3 years, not exceeding $31 million. So this language would allow these small businesses as defined to fully deduct R&E expenses, and they would therefore no longer have to do the 5-year amortization schedule. On the flip side, this is not a large business or just maybe not non-small business. These would be, so these businesses not defined as a small business would have to maintain the pre-HR1 treatment. And so for just their tax returns, sort of the net revenue impact is 0 for the large businesses, because that's our existing law. And so it's continuing Vermont existing law treatment for these large businesses. And so for the small businesses, that you'll see in the table that I have coming up, that represents a revenue decrease to the state because they are being able to fully take advantage of deducting all of their R&E expenses. So one piece of the same proposal is neutral, the other one is decreasing revenue a little bit.
Representative Odie, do you still have something? Representative Higley?
Do we know the numbers of small businesses compared to the large ones?
I do have that number, but not on my notes right now. So I'll send that to you when we're done.
Thanks.
Follow up to Rep. Higley's question. Do we know about the relative impact of small businesses versus large business?
Can you say that question again? I just didn't hear you.
Sorry. Do we know, following up on Rep. Higley's question, do we know about the relative fiscal impact of small business?
What do you mean by fiscal impact? What do you mean by fiscal impact?
Well, if this is going to change revenue to the state, based on how businesses treat deductions and this sort of stuff, what's the impact that we're concerned about in this committee?
Well, and I think the answer to that question will be illuminated a little bit in the summary table that I have in a couple of slides.
Okay.
But you'll see that large businesses have a much bigger revenue impact on the state.
Okay, that's good. Thank you, Patrick. Makes sense.
Yeah.
Sure. Couldn't we determine that by your previous slide that you said had the full vote decouple and then your new slide?
Yeah. Yeah, you can definitely make that comparison.
Okay.
Okay, so that is, sorry, this last one is the first instance where we have a part like link up and decouple. So we've gone through the areas where you'll see in the language, it's proposing to link up to federal treatment. The next couple I'm going to show you are areas where the language is proposing to decouple from federal treatment. So in HR1, there was a new bonus depreciation introduced for qualified production property. So rather than depreciating the cost of that property over a 39-year period. It's saying that you can claim that full bonus depreciation right away up front. And this applied to certain properties built or bought after January 19th of 2025. Don't ask me why it's such a specific date. What the language is doing is proposing that Vermont decouples from this treatment and requires businesses to do that 39-year depreciation. So spreading it out over a longer time period. And this is consistent with other areas of Vermont law when it comes to bonus depreciation. And actually, I think that was some of the justification why the tax department came in and requested this change. So the next piece is decoupling from the exclusion on gains from qualified small business stock. So there's kind of two parts to this. So HR1 increased or basically made larger the type of business that could qualify in terms of their aggregate assets. So made it so larger businesses could qualify to be a qualified small business stock, and also increase the amount that could be issued per issuer. And so on top of that, it also previously, if you held that qualified small business stock for 5 years, you could exclude all of the capital gains from selling that stock. The new language sort of phases in. So if you hold it for 3 years, you can exclude 50% of that capital gains, 4 years, 75, then again, 5 years, 100%.
So we still have all of the capital gains preferential treatment.
Yep, you have the capital gains exclusion, yes.
I mean, in this case, I assume some of the investors are also the people who set the value of those shares. So are there any rules or transparency around how the initial valuation is determined?
I'm not sure I'm in the best position to answer that question. But I can.
Did I send you that? Did I send everyone that really long report or just? Did I send that to you? Okay. Okay.
So in terms of setting the initial value, I guess I'm not quite sure the exact answer to that question. But so HR1 is expanding sort of the businesses that can qualify in the amount of the stock that can be sold per issuer. But what you'll see the language is doing is it's not just decoupling from the HR1 treatment, it's decoupling from the preferential treatment of these capital gains altogether. And so
they'd be treated like regular capital gains.
Right. And so one thing to remember.
Which gets preferential treatment already.
Right.
Yes. Okay.
And just one thing to remember when thinking about it, and I only bring this up because I always want to harp about like single sales factor and how that matters. This is not single sales factor, but what matters in terms of who's paying this is the domicile of the taxpayer. So if you are a Vermont taxpayer and you own qualified small business stock in a company in New Mexico and you sell that, this change would affect you. If you are someone in New Mexico with stock in a qualified small business stock in Vermont and you sold it, it depends on what New Mexico is treating that income like. Okay.
Do you think this might dissuade Vermonters from investing in startups in Vermont? Because, or in any startups, because it matters where they're domiciled, not where they're investing.
I mean, I suppose there could be some behavioral change. It's not something we've really modeled out, though.
I'm just thinking that you don't like the policy. Okay, but if Vermont investors are disadvantaged from making this kind of investment because they're domiciled here, but if you're domiciled anywhere else in the country, you want to make this investment. I just wonder if we really want to make it tougher for Vermont domiciled people to make this kind of investment, especially if they're looking at reinvestment one day in July and it's investment. I don't know if they do that, so I shouldn't have said the name, but there are places that try to help people who are starting up companies in Vermont. And that might appeal to a Vermont investor.
I mean, I think I'd sort of say that that's kind of a policy discussion for you all to have. And continue to think about perhaps.
I see the point I'm trying to.
I do, and that we're still leaving preferential treatment for capital gains, which is a lot of an incentive.
To me, that's not the question.
Yeah, I hear that,
If
yes.
we're allowed to have a policy discussion.
I'd rather we all actually understand what we're talking about before we have a policy discussion, because this continues to be slightly confusing to me, and I've like run through it every day for a month now, so maybe it's just me, but. So let's all like get our heads around what the proposal is, and then we can discuss it.
So yeah, I'll just say again, this is fully decoupling from any preferential treatment of these capital gains and treating it like regular capital gains in the Vermont tax code. So the section 250 deduction, the language you'll see is proposing to decouple from this deduction entirely. And you may also remember, this is something that when Carl Davis came in and talked about HR 1 impacts, this was something that he also put on the table for you all as a recommendation. So what HR 1 did was adjust the amount of foreign derived deduction eligible income, or FDII, domestic corporations could deduct from 33 to 33.34%. And then the net corporate or CFC, tested income, or necktie, as he called it, changed that to 40%. This is the thing we've talked about before, where on one hand, HR 1 was expanding the base of this foreign type of income. And then while they're expanding the base, reducing the deductions to sort of try and make administration of it a little bit simpler for them, but also not really try to ding corporations too much. And if you remember from, and one thing that's important to remember with federal treatment of this income is that they provide credits to corporations for foreign taxes paid. And so they rely sort of on that as a way to offset that, and the deductions to offset, some business activity that might not be specifically domestic, while also making sure that they're taxing this foreign income in light of, I think the narrative that you hear a lot is that corporations will set up a subsidiary in Ireland, park all their intellectual property there, and essentially charge the parent corporation, the domestic corporation, royalties for use of the patents. It's sort of like the anecdotal narrative around some of this income, but maybe to help you sort of remember what the kind of income we're talking about here. And so just to quickly define the two different ones, today is that income earned by domestic corporations for exporting property or services for use outside of the United States. And NECD is the aggregate of a U.S. shareholder's income from all of their CFCs. That shareholder can be a corporation, and often is. So think of that kind of as their foreign subsidiaries. And it's all part of the unitary group, which Vermont is very clearly defined. And the last time we very much reviewed corporate income taxes. And so part of the sort of proposal that was put forth when Carl was here was that Vermont doesn't have these credits for foreign taxes paid. This income, and if you remember the apportionment equation that I've shared with you all in the past, basically you're selling for today, you're selling out of country to a foreign country. When you think about the single sales factor, your total sales in the denominator is going to increase, but sales into Vermont is not going to, right? So that part of the equation is not changing. So what does change is the total net income by removing the deduction increases, but you're also seeing an increase in the sales factor because, or sorry, a decrease in the sales factor because the denominator is increasing, making the allocation smaller. So really the argument that was put forward to you when Carl wasn't here was let the single sales factor do the work of apportioning this. Don't rely on deductions, especially when you don't have, the foreign taxes paid credits that you would offer, that the federal government offers to these corporations. So the language is decoupling, saying these deductions are no longer allowed. It's putting the full weight of all this income into the apportionment schedule and letting it be apportioned sort of regularly that way. So that's foreign income. The next change was just, I know you're all familiar with this, but there's currently a $3 million cap on the amount of credits that the Vermont Downtown Development Board can award any given year. This language is proposing to increase that amount by 1 million. And again, these credits are issued to people who are doing the project, but they're often sold to banks or insurance companies. They can be claimed to offset personal or income taxes for the persons issued to, but more often they're sold to banks, insurance companies, as it can also provide capital for the project being undertaken, which include things like historic rehabilitation, facade improvements, code compliance, and flood mitigation.
Just to be clear, this has nothing to do with H1. This is our policy decision.
Oh, yeah.
Yes.
Just there was a transition there. And just given the conversation that happened yesterday, was there discussion in appropriations of the merits of a credit versus an annual appropriation?
So, the reason so we're like sort of going to the full miscellaneous tax bill here. Pat and I did some math with all of the ups and downs from like the fiscal year we're living in, next year and the year after, to try to make the full miscellaneous tax bill revenue neutral. And so that's why this was $1 million. I think we originally talked about 2 million in committee.
I thought we were going up 3 million.
We're going up from 3 million. I think we were previously talking about adding 2 million. But in order, that would make the bill revenue negative, and so.
I'm not understanding.
Oh,
You
okay.
just like, that was a whole other thing I hadn't
Oh,
thought about.
okay, cool.
Because we're using, and
Yeah.
maybe you told me, fine, don't understand. I'm trying to figure out why. There's a federal link up or not that we have to do separately. Separately, we have a village and downtown tax credit program. My question was there conversation appropriations about the merits of using tax credits versus annual appropriations the same amount?
For tax credits.
And because they accomplish the same thing, one has, gives corporations a broader perspective on what state revenues they're managing. And then you introduce a whole other piece that I hadn't thought about, which is, are we changing the village and tax credit because we think it's a good policy change, or are we doing it to make a revenue neutral miscellaneous ed bill? In which case, I don't understand the logic of that.
So we all thought, we talked about the downtown village center tax credit here. I think we put it in our letter to ropes, maybe. No, okay. But it's been in here already.
Yeah.
Thank you. Okay. And brought it down from sort of the $2 million that wasn't here to the 1 million in order to make this bill not be negative.
Okay.
Appropriations has historically, like, this is one of the tax credits that everyone's been like comfortable with and seen as a good thing. Commerce, to my understanding, also put this in their letter to approps. I'm hoping that in future years, and I started a conversation with other chairs about this, that, the process of appropriations letters, we could have somewhat of a parallel process with revenue letters so that committees policy committees would have, frankly, mostly the Commerce Committee, but partly the Human Services Committee, would have a regular chance to evaluate the tax credits that benefit their policy areas instead of just thinking, instead of sort of forgetting about them to some degree.
Yeah, well, I think that's my concern, and it's not a judgment on the value, these are valuable programs, just to be really clear, but I think when they're coming as credits as opposed to appropriations, it's very easy to lose track of our total spend. And also, we don't pay attention to whether they're achieving what we think they're achieving.
This one, in my experience, gets like fairly regular annual check-ins from us and from Commerce. And I told Representative Odie that we weren't going to talk about the policy merits of each section. We were just going to understand this in here. And then I did it.
I'm sorry.
She actually forgives me.
I understand you want to make this revenue neutral, but I think it's such an important thing that I would be willing to go over revenue neutral to put more money toward it.
I would love that if we could get a bill to appropriations that they're not going to amend once they get it. That's one of my goals for our committee.
So it won't, you think
Mine
that,
is tight and
I'm just asking a question. Alan.
Yeah.
If you, is this, their feeling is if it's revenue neutral, they're really gonna leave their hands off of it?
There are no promises in this world.
Well,
But
I
yes, that is
said,
right.
you see more toward this, I think,
But I think that they're much more likely to leave it alone if we do that. Yes.
for an extra million.
They're looking for like $10 right now down there.
It's just that our rural towns, the ghetto towns. That's what I want to say, and I.
Agreed. I think it's actually a huge step forward that we're increasing this by $1 million. They've been asking for that for a long time.
Okay. I mean, I'm not paying, okay.
I'm just gonna say 1 more million won't matter, to be honest with you. So,
I mean, I know it's a lot.
Okay, we're good.
It's very helpful.
Sorry to say
for
that.
small
No, I
towns.
hear you.
Let us move on to the next one because it seems like everyone understands this tax credit.
Yeah, this is the fun one.
And just to.
I think lots of fun in here.
Just to ease any of the confusion from before, so we went through the link up sections, we went through the decouple sections. Everything else we're talking about next is sort of additional stuff, things affecting existing law. The second one, and I know you had Maura Collins in here to talk you through their request, but this is basically allowing HFA, authorizing them to issue sell $350,000 in total first year credit allocations. And this supports the loans that they provide for the down payment assistance program. As they had authorization for $250,000 in these credits through 2026, fiscal year 26. And so what you're doing is, what you would essentially be doing by including this language is extending that program out to 2031 and increasing the amount of the credits that can be allocated to 350,000. I think the easiest way to understand the fiscal impact of this is this chart that Maura has created. And it just shows you, so in blue, you see the current commitments, that was the credits that were allocated by VHFA at the $250,000 level. You can see that they're spread out over 5 years. They have this tail effect to them. So you can see in the blue that in 2026, those credits that have been allocated will be sort of ending in fiscal year 30. But by including this language in the green here, you can see that they still will have the ability to continue allocating these credits going into the future at this different level. So the single year impact for fiscal year 27, you'll see that first year that the green sort of shows up right here. The fiscal impact based against current law there would be 350,000. Because they're allocating these credits each year, that does increase over time with the tailed effect of these credits. And you can see that in fiscal year 31, that revenue impact would peak with the net difference being 1.75 million. So it's something that does grow over time because these credits have the tailed effect. But really what this is also doing is just extending a program that's currently happening. And there are credits that have been issued that will continue to, go towards this fiscal impact until 2030. So there's one more proposal on the table in front of you, and then we can look at everything together in one table. So Vermont currently has a state research and development credit, and it's equal to 27% of what the federal credit allows for eligible research and development expenditures. Specifically, these expenditures have to occur within Vermont. So the R&D has to take place here. And if you're not able to, if you don't have the liability to offset with these credits, you can carry the value of the credits forward up to 10 years. So if you don't have the tax liability to offset, it's not like you just lose the credit. You can still carry that amount forward up to 10 years. One thing that is important to note about this credit is it does kind of require that you have to have increasing R&D expenses over time. So what you can do is so the credit is equal to 20% of these eligible expenses. But it's the difference between the 4-year average of what your R&D is. So, sorry, let's take a step back. Think of a 5-year window, the 5th year being the one that you're in. In years 1 through 4, you would take those R&D expenses and get the average amount. In year 5, you're comparing that to the previous 4 years average. And the difference, the amount over that baseline amount, that's the amount that's eligible for the credit. So that, and if you're going to be persistently claiming this credit over time, that sort of dynamic is why you would have to have sort of increasing R&D expenses over time. And that in and of itself is already a bit of a simplification of the credit. But the crux there is it does sort of require increasing R&D expenses over time. So the language that you'll see is proposing to increase the Vermont state level credit, which again is only for activity in the state, from 27% to 75%.
My understanding is in doing this, we'll have the highest one in the country.
That's correct. Okay, everything put together.
Could you go back a slide? For a minute? Differentiation on small or large business on this.
Can you speak up?
Just thinking, I guess we'll wait till the next slide. Sorry.
If you are curious what businesses claim this credit, the tax department does publish a report every year saying specifically which ones do claim it. I know personally when I looked at it, I saw a lot of familiar names.
You shared with us a list before.
Yes.
I did share a great.
Does the tax department have the same on the people who qualify for the small business shares credit?
Are you talking about the?
That's going back to the federal one, the qualified small business share, whatever.
I know that the deputy director of the tax department is here and she might be able to.
The
Answer
qualified
that
small
question.
business stock gain exclusion, the ones affected by that, do we know who those businesses are in Vermont? If they're-
We can ask her when she comes up. But I will say that one of the reasons, it's having this list has been really helpful for policymaking to actually expand this credit. And the list exists because when the original credit passed, it included a provision to publish that data, which is really like remarkably unusual. And
Good.
I think it's interesting, like, I think generally when that kind of data is published, people, or is requested, there's sort of an assumption it'll be used to like do something nefarious, and we are using it to increase the credit. And so I just think it's like an interesting lesson for us all that I'm now gonna
Sounds like
hammer.
a good thing for an op-ed.
Sure, it might just be a good thing for us to remember to request that data be published in the future,
Yeah.
yes.
Maybe we can even look at tax expenditure.
Yeah.
Yeah.
Shall we go to the next one?
Sure.
Before everyone looks at this number, I just want to say the full bill that we're looking at, the full miscellaneous tax bill, is going to include those, right now, as drafted, includes those purchase and use changes. So the total bottom line of the bill will be different than this.
And I know for tomorrow, we'll have the fiscal note, which will have that all sort of put together for you.
Okay.
Everything with the P and U and all that stuff. So this is everything that I just summarized. You can, if you think back to a table for fiscal year 26, instead of a negative 21 million, you've got about a negative 4 million there. And for fiscal year 27, instead of a negative, I think it was 35 million. This actually becomes net revenue positive come fiscal year 27. And yeah, I mean, this the breakdown of how those different changes sort of flow through.
I continue to struggle to understand what revenue loss looks like in a year that the budget adjustment already passed. And so I just want to like refresh my brain on it. So I should be thinking of this more like I should be subtracting that 3.96 from the 14.25 to think about what FY27 really is. Okay.
Yeah, so the net change there, it's about 10.3 million.
Which is right around what that purchase and use loss to the general fund is. It's kind of magic. That's kind of magic.
I wouldn't call it that.
Any questions for Pat? Yes.
I'm gonna have to go through this all again.
Yes.
We have this recorded somewhere and it'll be on our data.
Do you mean the YouTube video?
I mean, the records. Maybe, is it on the?
I'll show you where it
Yeah, it's all everywhere.
Yeah.
Yes, okay.
All right.
First I can send it
Just
to
saying,
you.
I
Okay, yes,
can't get it all in one shot.
it's me either. Yep. Okay, yeah.
I know this is a question for whom, but, what about all the other provisions that were in our miscellaneous tax bill? Where are those?
So we're gonna finish hearing from Pat and understanding this, then we're gonna go through the miscellaneous tax bill with Kirby, including the section by section. And then we're gonna hear from tax department about the whole thing.
Thanks.
Anything else for Pat?
Yes. Well, I'll be hanging out
Great,
if something comes up.
thank you. We're gonna take a 5-minute break before we hear from Kirby for our brains. And